The Treasury Committee is looking into the banking inquiry. When I go back next week, I'll have about 7 or 8 sessions on the banking inquiry. It will focus on A, how did we get here? B, what do we do now? And C, what's the future going to look like in terms of regulation? Well, the reason we got here is quite simple, is there was an underpricing of risk by banks and by executives. And what does that mean? It means that with a low inflation, low interest rate environment, so the yields were not high enough for some people, so they invested. And they largely invested in complex financial products. I had the chief executive, so the chairman of Deutsche Bank before my committee. And we've got these wonderful complex financial products, CDOs, collateralized debt obligations or whatever. So my first question to the chairman of the Deutsche Bank was, Lord Aldington, can you explain to me what a collateralized debt obligation is? He says, oh, I'm not here to explain that. I says, funny, you've only got £1 billion worth of it in your books. And people didn't understand what they were devising, the product, and they didn't understand what they invested in. So the complexity was a bit of security for investors. They felt that would give them that security. And the whiz kids, the PhDs, the young guys who devised the mathematical models for the products, which gave them fact tails, in other words, which gave them probabilities, realised that when they were in the marketplace that those probabilities, equations, just didn't stand up. And that's why we're in the situation. So, product complexity. So, in terms of going forward, what should we do? Well, one question I've asked for quite a number of years, different members of the Monetary Policy Committee, the Governor and others who come before us, is where's the risk? And see, what they would say is that, look, well, we're living in a different world now. See, when you got your mortgage, or when you got refused with the Dunbarton Society, the reason they refused you is that you asked them for a mortgage and they were going to give you the mortgage, but they held the risk, most of the risk. But see now, the world we're in an originate distribute world, where the risk is sliced and diced and it's off the books. So we don't hold the risk. So that wonderful world of securitisation, which means the risk's off the books, means that we can go and get money and we can get it loaned again. But the question kept coming back, well, if there's a risk, who's holding the risk? And the products were so complex and the paths of investment were so complex that they didn't know who was holding the risk. And people in the banks themselves don't know who's holding the risk. So David and I, just before we come in here, are saying, well, there are some banks yet who haven't written down all their bad debts because they don't know at the moment what's on their books. But they'll have to make every effort to get those bad debts written off, because what we need above all is we need a floor on the debts. In other words, if we get a floor in assets, we can price the assets and then we can work out and we get a sensible system back again.